November 25, 2008, 2 months after the Lehman Brothers collapse. The Federal Reserve announced something the world had never seen before. They would create $600 billion out of thin air and use it to buy mortgage-backed securities and government debt. They called it quantitative easing, QE for short. It sounded technical, boring, like arcane central bank policy. It wasn't. It was the most radical monetary experiment in human history. Over the next 15 years, the Federal Reserve would create over $9 trillion. Not print it, create it, electronically conjured into existence with keystrokes. They used this money to buy government bonds, mortgage securities, and corporate debt, flooding the financial system with cash. The stated goal: prevent another Great Depression, save the economy. The actual result: the greatest wealth transfer in history, and everything bubble in stocks and real estate, and inflation that's now destroying the middle class. This is the hidden story of quantitative easing, the $9 trillion experiment that changed everything, and why the bill is finally coming due.
In 2008, after the banks were bailed out with $700 billion in TARP funds, the global economy was still dying. Credit markets were frozen, banks weren't lending, businesses were failing, unemployment was soaring toward 10%. The recession was spiraling into something far worse. The Federal Reserve's traditional tool for fighting recessions was lowering interest rates. When the economy slows, the Fed cuts rates, making borrowing cheaper, which encourages spending and investment. Simple, effective. But in 2008, there was a problem. Interest rates were already at zero. The Fed had cut rates to essentially 0%, and it wasn't enough. They were out of ammunition. So, Fed Chairman Ben Bernanke, an academic who had spent his career studying the Great Depression, decided to try something unprecedented, something that had only been attempted once before in Japan in the early 2000s, with mixed results. He would create trillions of dollars out of nothing and use that money to buy assets directly from the financial system. He called it quantitative easing. The official story: QE would stabilize the financial system, lower long-term interest rates, and stimulate the economy by making credit available again. The hidden reality: it would become the greatest transfer of wealth in history, inflating asset prices to absurd levels, destroying the value of savings, and creating an addiction to cheap money that the economy can't kick. This is the story of that experiment: how it worked, who it helped, who it destroyed, and why we're all paying the price now. Most people have no idea what quantitative easing actually is. That's by design. The Federal Reserve uses technical jargon to obscure what's really happening. Let me translate it into plain English. Quantitative easing is when the Federal Reserve creates money electronically and uses it to buy financial assets, primarily U.S. Treasury bonds and mortgage-backed securities. They're not printing physical cash. They're creating digital dollars with a computer keystroke and adding those dollars to the accounts of banks and financial institutions. Here's how it works in practice. Let's say you're a major bank like J.P. Morgan Chase and you own $100 billion in U.S. Treasury bonds. The Federal Reserve calls you up and says, "We'll buy $10 billion of those bonds from you." You agree. The Fed creates $10 billion out of thin air, electronically, and deposits it into your account at the Federal Reserve. In exchange, you transfer ownership of $10 billion in Treasury bonds to the Fed. Now you have $10 billion in cash sitting in your account instead of Treasury bonds. The Fed's stated goal is that you'll use that cash to make loans to businesses and consumers, stimulating the economy. But here's what actually happened. Banks took that cash and did other things with it. They bought stocks, they bought corporate bonds, they bought real estate, they speculated in financial markets. Some of it went into lending, but a huge amount went into inflating asset prices. The Federal Reserve conducted quantitative easing in multiple rounds, which they called QE1, QE2, QE3, and so on. Let me break down the timeline. QE1 began in November 2008 and ran through March 2010. The Fed created $1.25 trillion to buy mortgage-backed securities, $300 billion to buy Treasury bonds, and $175 billion to buy debt from Fannie Mae and Freddie Mac. Total, about $1.75 trillion created and injected into the financial system. After QE1 ended, the economy was still weak. So in November 2010, the Fed launched QE2. They created another $600 billion to buy more Treasury bonds. The economy improved slightly, but not enough. In September 2012, the Fed launched QE3, also called QE Infinity, because it had no end date. The Fed committed to buying $40 billion in mortgage-backed securities every month, indefinitely, until the labor market improved substantially. They later increased it to $85 billion per month. QE3 finally ended in October 2014. By that point, the Federal Reserve's balance sheet had exploded from $900 billion before the crisis to $4.5 trillion. They had created nearly $4 trillion in 6 years, but the story doesn't end there. In 2020, when COVID hit and the economy locked down, the Fed went into overdrive. They launched what some called QE4 or QE Infinity 2.0. In just 18 months, from March 2020 to June 2021, the Federal Reserve created another $4.5 trillion, doubling their balance sheet from $4.5 trillion to $9 trillion. Let that sink in. In the decade from 2008 to 2018, the Fed created about $4 trillion. Then in 18 months during COVID, they created another $4.5 trillion. The money creation accelerated dramatically. So what did all this money printing actually do? The Fed will tell you it prevented a depression, saved millions of jobs, and stabilized the financial system. And there's some truth to that. But it also did something else, something they don't advertise. It inflated the biggest asset bubble in human history. When the Federal Reserve creates trillions of dollars and pumps it into the financial system, that money has to go somewhere, and it went into assets, stocks, bonds, real estate, anything that could be bought and sold. The result was the everything bubble. Let's start with the stock market. In March 2009, at the bottom of the financial crisis, the S&P 500 was at 676 points. By February 2020, before COVID, it had risen to over 3,300 points. That's a 400% increase in 11 years. Was the American economy 400% more productive? No. Was corporate profitability up 400%? No. What happened was the Federal Reserve flooded the system with so much money that it inflated stock prices to levels disconnected from economic reality. Then COVID hit, and instead of crashing permanently, the stock market rebounded faster than ever. Why? Because the Fed immediately announced unlimited QE. They would create as much money as necessary to support asset prices. And it worked. By early 2022, the S&P 500 hit 4,800, up another 42% from pre-COVID levels. During a pandemic, while millions were unemployed, the stock market was booming because the Fed was printing trillions. Who owns stocks? Not working-class Americans. About 10% of Americans own 89% of all stocks. The wealthiest 1% own about 54% of all stocks. So when the Fed inflates stock prices with QE, they're directly enriching the already wealthy. Now let's talk about real estate. In 2012, the median U.S. home price was about $225,000. By 2022, it had risen to over $420,000. That's an 87% increase in a decade. Again, were American wages up 87%? No. Median household income went up maybe 25% in that period. So how did home prices almost double? Quantitative easing. The Fed wasn't just buying treasury bonds. They were buying mortgage-backed securities, hundreds of billions of dollars worth. When the Fed buys MBS, it pushes mortgage rates down artificially. Lower mortgage rates mean people can borrow more money to buy houses. More borrowing power means they can bid up home prices. And that's exactly what happened. But here's the cruel part. If you already owned a home, you got richer. Your home equity skyrocketed. If you were trying to buy your first home, you got priced out. An entire generation of young Americans, millennials and Gen Z, found themselves locked out of home ownership because the Federal Reserve's policies inflated home prices beyond their reach. The wealth transfer was staggering. From 2009 to 2021, American billionaires saw their wealth increase by $2.1 trillion. Jeff Bezos's wealth went from $18 billion to over $200 billion. Elon Musk went from essentially broke to the richest person on Earth, worth over $200 billion at his peak. How? Not because they suddenly became 10 times more productive, because the Federal Reserve's money printing inflated the value of their assets, their stock holdings, their companies. Meanwhile, what happened to regular Americans? If you had savings in a bank account, your money lost value. The Fed kept interest rates at zero, so savings accounts paid nothing. Inflation, even the official inflation rate, was 2 to 3% per year, which means your cash was losing purchasing power every year. You were being slowly robbed. If you had a 401k invested in stocks, you benefited somewhat. But most Americans don't have significant retirement savings. 50% of Americans have less than $10,000 saved for retirement. So the stock market boom didn't help them. What quantitative easing did was create a two-tier economy. If you owned assets, stocks, real estate, businesses, you got richer. The Fed's money printing inflated the value of everything you owned. If you lived on wages and savings, you got poorer. Your paycheck bought less, your savings earned nothing, and the cost of housing, education, and healthcare skyrocketed. The Federal Reserve will tell you QE saved the economy. What they won't tell you is it saved the economy for the rich while sacrificing everyone else. Here's a stat that summarizes it perfectly. From 2009 to 2021, the richest 1% of Americans gained $30 trillion in wealth. The bottom 50% gained essentially nothing. That's not a coincidence. That's the direct result of Federal Reserve policy. For years, the Federal Reserve insisted that quantitative easing wouldn't cause inflation. They created trillions of dollars, but they promised it would stay in the financial system, boosting asset prices without causing consumer price inflation. For a while, they were right. From 2010 to 2020, official inflation remained relatively low, around 2% per year. But there were warning signs. Housing costs were skyrocketing. Healthcare costs were rising. Education costs were exploding. Stock prices were detached from reality. These were all forms of inflation, but the Fed's official measure, the Consumer Price Index, didn't fully capture them, so they kept printing. Then COVID happened. The Fed created $4.5 trillion in 18 months. The government sent out stimulus checks totaling trillions more. All that money flooded into the real economy, not just financial markets. And something the Fed insisted couldn't happen, happened. Massive consumer price inflation. By mid-2021, inflation was clearly accelerating. By early 2022, official inflation hit 9.1%, the highest in 40 years. Gas prices doubled. Grocery prices surged. Rent skyrocketed. The cost of everything exploded. The Fed initially called it transitory, a temporary blip that would resolve itself. They were wrong. It wasn't transitory. It was the inevitable consequence of creating $9 trillion out of thin air. Here's the brutal reality. Inflation is a hidden tax. When the Federal Reserve creates trillions of dollars, they're diluting the value of every dollar you already have. Your paycheck is still the same number on paper, but it buys less. Your savings account still shows the same balance, but it's worth less. You're being robbed slowly, invisibly, by monetary policy. And unlike regular taxes, which require Congress to vote and can be debated publicly, this inflation tax happens silently, through unelected Federal Reserve officials making decisions in closed meetings. You don't get a say. You don't get to vote on it. You just pay the price. Let's put this in concrete terms. In 2020, the median household income in America was about $68,000. By 2023, after 3 years of high inflation, that same household needed about $81,000 to maintain the same standard of living. That's a $13,000 annual inflation tax on the median family. Most people didn't get $13,000 in raises, which means their standard of living declined. Meanwhile, what happened to the wealthy? Their assets, their stocks, their real estate went up in nominal value along with inflation. Jeff Bezos's wealth inflated right along with grocery prices. Your Amazon stock went up. So did the price of eggs. But if you don't own stocks, you just got the higher egg prices. The Federal Reserve created this inflation through QE, then acted surprised when it showed up. But economists had been warning about this for years. You can't create $9 trillion out of nothing without consequences. Money supply expanded by over 40% in just 2 years during COVID. Of course, that caused inflation. And now we're living with the consequences. The Fed is trying to fight the inflation they created by raising interest rates aggressively, which is causing a different set of problems. Higher rates mean higher mortgage payments, higher credit card bills, higher business loan costs. The economy is slowing.
Layoffs are increasing. We might be heading into a recession. So let's recap. The Fed created trillions through QE, inflated asset prices benefiting the wealthy, then caused consumer price inflation that hurt everyone else. And now they're raising rates to fight that inflation, which is causing economic pain. At every step, regular Americans pay the price. For 15 years, quantitative easing seemed like a miracle drug. Every time the economy weakened, the Fed would create more money, buy more assets, and prop everything back up. Stock market crash, print money. Recession threat, print money. Pandemic, print money. It became the solution to every problem. But like any drug, there are side effects. And like any addiction, eventually you have to face withdrawal. The first problem, the Fed created an economy completely dependent on artificially low interest rates and constant money printing. Businesses took on massive debt because borrowing was so cheap. The federal government exploded its debt because the Fed would always buy the bonds. Stock valuations reached absurd levels because investors assumed the Fed would always step in to prevent crashes. Everyone got addicted to free money. Then in 2022, the Fed had to stop. Inflation was out of control. They couldn't keep printing money while prices were rising 9% per year. So they did something unprecedented. They started quantitative tightening, QT. Instead of creating money and buying assets, they started letting their balance sheet shrink, effectively destroying money and removing liquidity from the system. The results were immediate. The stock market crashed in 2022, down over 20%. Bond markets saw their worst losses in decades. Real estate started declining in many markets, and the economy began showing signs of serious stress. Here's the deeper problem. The Fed's balance sheet is still $8 trillion, down from $9 trillion, but still massive. They own trillions in government debt and mortgage-backed securities. They can't just dump all of that back into the market without causing a crash, so they're stuck. They can't fully reverse QE without destroying asset prices, but they also can't keep printing money because inflation is still elevated. It's a trap of their own making, and the exit strategy isn't clear. Meanwhile, the addiction to cheap money has created fragility throughout the entire system. Zombie companies that should have gone bankrupt years ago are still alive, kept breathing by cheap debt. Government debt has exploded to over $34 trillion, which is only serviceable because rates were kept artificially low for so long. Now rates are higher, and the interest payments on that debt are becoming unsustainable. The banking system itself is fragile. In March 2023, Silicon Valley Bank collapsed, the second largest bank failure in U.S. history. Why? Because they held long-term bonds bought when rates were near zero, and when rates rose, the value of those bonds crashed, rendering the bank insolvent. Other regional banks face similar problems. The Fed's policies created this vulnerability. So what happens next? There are really only two paths forward, and neither is good. Path 1. The Fed continues to fight inflation with high rates and QT. This causes a severe recession, massive job losses, and a wave of corporate bankruptcies and bank failures. Asset prices crash. It's painful, but it purges the excesses built up over 15 years of QE. Path 2. The Fed gives up on fighting inflation and goes back to QE. They start printing money again to prop up failing banks and prevent the recession. Inflation comes roaring back. Your savings get destroyed. The dollar loses even more value. Eventually, we face either hyperinflation or a currency crisis. The brutal truth is there's no painless way out. The $9 trillion experiment has consequences, and we're about to experience them. For 15 years, quantitative easing let us pretend we could have something for nothing. We could bail out banks, inflate asset prices, suppress interest rates, run massive deficits, and never face any consequences. But economics doesn't work that way. You can delay the pain. You can push the reckoning down the road. But eventually, the bill comes due. And it's coming due now. Quantitative easing was sold as a temporary emergency measure to save the economy in 2008. It became a permanent feature of the financial system, a $9 trillion experiment that transferred wealth from the poor to the rich, inflated asset bubbles, destroyed the value of savings, and ultimately caused the inflation crisis we're living through now. Was it worth it? Did it save us from a depression, or did it just delay the pain while making the eventual reckoning even worse? The answer depends on who you ask. If you're a billionaire whose net worth quintupled, it was a miracle. If you're a working-class American whose wages stagnated while costs exploded, it was a disaster. One thing is certain: the age of quantitative easing is ending, and the consequences are just beginning. If this opened your eyes to how the financial system really works, hit that like button, subscribe for more investigations into the hidden machinery of our economy, and comment below: do you think QE saved the economy or destroyed it?